Welcome to the Deep Dive. Today, we are putting a spotlight on Dash, a cryptocurrency that, well, it launched with a very simple but pretty ambitious mission. To be real digital cash.
Yeah.
We're talking speed, security, really low costs. The whole idea wasn't just, speculation. It was about everyday use.
And that goal, that utility, creates this huge paradox we're going to explore, because technically Dash has features. Well, things like near-instant transactions, a working decentralized governance, features its rivals. Even the huge ones still kind of struggle with.
Right.
But, and here's a paradox, despite being ahead technologically, it's had, well, immense struggles with market value. And there's been this deep ongoing debate within the community about its governance, how it funds things.
Exactly. So that's our mission today. We're going to try and reconcile those two sides. We'll unpack the tech InstantSend, the masternodes, all that.
Cool stuff.
Yeah, the cool stuff. And then we need to honestly look at the governance issues, the criticisms the community itself raised. And of course, we have to factor in this, well, pretty surprising market turnaround it's having right now here in late 2025.
And just to set the stage, think about this key fact. Dash claims transaction speeds under a second.
Under a second.
Yeah, and costs often under a penny. Now, compare that to the usual crypto experience.
Right.
Waiting 10 minutes, maybe much longer if the network's busy.
Yeah.
Dash was built specifically to kill that friction, make it practical for, buying a coffee, not just holding as an asset.
Okay. Let's get into that innovation then, starting with the architecture. Yeah. It's different from Bitcoin, right? It uses a two-tier network.
Correct. Tier 1 is pretty standard, proof of work mining, computers solving problems to secure the chain, basic stuff.
Got it.
Tier 2, though, that's the distinctive part. That's the masternode network.
Okay, masternodes. What exactly are they? Specialized servers.
Yeah, specialized and incentivized servers. They're not just validating blocks.
Yeah.
They do the heavy lifting for advanced functions, InstantSend for speed, Darksend for privacy, and, crucially, they handle the voting for governance.
Right. And running one isn't trivial. You have to put up serious collateral, don't you?
You do. Operators have to lock 1,000 DAsh.
1,000 DSH. And based on prices earlier this year, May 2025, that's what, around $24,000?
Yep, roughly $24,000. It's a significant commitment.
It really is. So what's the thinking there? Why such a high barrier? And what's the incentive, the reward structure?
Well, the high collateral creates a strong vested interest. That's the main goal. The idea is if you have that much skin in the game, you're incentivized to act honestly and support the network long term.
Protect your investment.
Exactly. Plus, it takes DASH off the market, potentially reducing volatility. But for incentives, locking up that capital earns you a return, a dividend.
And that used to be pretty decent, right? Like 7 to 10% ROI from the block rewards. About 45% of the reward goes to masternodes.
Historically, yes, it was a solid passive income stream. But as our sources note, that ROI has dipped recently. It's closer to maybe 5 to 7%.
Okay, so here's my question then. In today's crypto world, you've got proof of stake, DeFi yield farming, lots of ways to earn passive income, often with lower barriers and maybe even better returns. Why lock up $24,000 for 5-7% running a technically demanding masternode? Does the utility alone justify that cost now?
That's a really critical point, and it gets to how the incentive model has maybe shifted. The ROI, you could argue, is now sort of a secondary benefit.
Oh, interesting. So what's primary?
The primary compensation, I think, is becoming the governance power and the utility those masternodes enable. You're not just staking for yield. You're running the core infrastructure for things like InstantSend, and you get a direct vote on how the treasury, the DAO funds are spent.
So it attracts people invested in the platform itself, not just yield chasers.
That seems to be the idea. It inherently prioritizes operators who care about the long-term function and direction rather than just, maximizing short-term APY.
Okay, but that high collateral, the technical know-how, doesn't that also mean governance power ends up concentrated in the hands of, well, relatively few people, a few thousand masternode operators making the big decisions? Sounds a bit centralized in a way.
It's definitely a specific model. They often call it decentralized governance by stakeholders. The bet is that those with significant capital locked up have the most to lose, so they'll make the most prudent long-term choices. It's kind of an incentivized meritocracy based on capital commitment.
An incentivized meritocracy.
Bad.
Okay, let's talk about the killer app enabled by this system, InstantSend. Speed is crucial for merchants, as you said. 10 minutes is just impossible at a checkout.
Absolutely. Waiting kills adoption. So Dash tackled latency head-on with InstantSend, originally called InstantX. It gets settlement down under 2 seconds.
Under 2 seconds, wow.
And crucially, it makes that transaction final, tamper-proof without needing a central authority. It uses the Masternode network in a clever two-step process.
Okay, walk us through step 1, transaction locking.
Right. So when you send Dash with InstantSend, your wallet basically broadcasts an intent to lock those specific coins to the recipient's address. It's like saying, these funds are committed right now. This immediately prevents them from being spent elsewhere, the double spend problem.
So it preempts the issue instead of waiting for confirmation.
Exactly. On slower chains, you need those multiple block confirmations to be sure. Transaction locking is like an instant guarantee flagged across the network.
And then the masternodes jump in immediately. That's the masternode locking authority part.
Precisely. The network instantly picks a small group of masternodes. They call it a quorum, like 10 masternodes.
You have
just
10.
Yeah, a small, fast group. They immediately validate that lock request. They don't wait for a block. If a supermajority, say 60% or more of that quorum, agrees, bam, the transaction is locked, confirmed, final.
In seconds.
In seconds. The merchant knows the funds are secured.
That is elegant. Using the masternodes as this sort of instant confirmation layer outside the normal block process. And it's not just theory, you mentioned adoption. The sources say Dash has something like 7 times the number of physical merchant locations accepting it compared to Bitcoin. Places like Subway, Lowe's.
Yeah, they really made inroads into actual point of sale, which is, frankly, still a huge hurdle for most cryptocurrencies trying to be actual cash.
Okay, let's shift from speed to user experience and privacy. Dash evolution was a big push there, right? Aiming for mass adoption.
Yes, definitely. Evolution was conceptualized way back around 2015. They saw that crypto wallets were, let's be honest, often clunky and intimidating.
Like spreadsheets for nerds.
Pretty much. They wanted Dash to feel as easy as, Venmo or PayPal. So they introduced the decentralized payment name service, DPNS.
So human-readable usernames instead of those crazy long addresses.
Exactly. No more copying and pasting those error-prone strings. Send money to Bob instead of XUZ.
That alone is huge for usability.
It is. And they added other user-friendly things. Contact lists built in, ways to easily request payments or send invoices, even setting up recurring payments right from the wallet. Things needed for real commerce.
Makes sense. And what about the privacy side? Darksend.
Right, Darksend. It's built on the CoinJoin concept, aiming for privacy and, importantly, fungibility.
Fungibility meaning each Dash is the same as any other, no tainted coins.
Exactly. Darksend works by mixing transactions. It uses specific common amounts like 0.1, 1, 10, or 100 DAH, and requires at least 3 people in each mixing round done by a masternode. This muddies the waters, making it hard to trace specific payments.
I saw something in the notes about resisting specific tracking methods, like forward change linking and through change linking. Sounds technical. How does Darksend beat those?
Yeah, those are techniques analysts use to try and follow the money, especially the leftover change from a transaction back to the sender. Darksend uses what they call a chaining approach. Your transaction doesn't just get mixed once. It gets passed through multiple masternodes, undergoing several rounds of mixing.
So layers of mixing.
Kind of. Multiple hops, multiple mixes, using those standard denominations. It dramatically increases the complexity for anyone trying to trace the original source or follow that change. It's basically obfuscation through multiple incentivized steps.
Clever. And development hasn't stopped. They're working on EVM compatibility now with platform v2.0.
Yeah, that's a big strategic move. EVM, the Ethereum virtual machine, is basically the standard for smart contracts and DeFi.
Decentralized finance.
Right. By adding EVM compatibility, Dash is signaling it wants to be more than just digital cash. It wants to attract DeFi developers and projects, potentially opening up a whole new ecosystem. It's a play for broader relevance.
Okay, but this brings us to the core puzzle. The huge question mark hanging over Dash. All this tech, the speed, the privacy features, the UX focus. Why didn't the market reward it historically? You mentioned the price, an all-time high near $1,600 in 2017, but then down around $25 just last year in mid-2024. What happened?
It's baffling, honestly, especially when you see its actual use. Like we said, it's a genuine lifeline in places like Venezuela, Zimbabwe, because it works, it's fast and cheap.
So the tech delivers utility there.
Absolutely.
Right.
But back home, let's say, in the broader crypto community discussion, the focus shifted heavily onto criticism of its internal funding, the DAO.
The Decentralized Autonomous Organization, the system that funds development using block rewards voted on by masternodes. And the criticism we found was Harsh. Calling the DAO Dash's major handicap the main reason for its failure.
Yeah, some critics were really scathing. The core argument was that the DAO, which gets about 10% of block rewards, became a system that finances promises, not results.
Okay, explain that. How did that happen in practice? Why would the masternode operators, the ones with 24K locked up, keep voting for projects that didn't deliver?
It seems it was less about bad intent from the voters and more about, well, a structural lack of accountability combined with maybe some misplaced optimism or insufficient vetting.
So someone proposes a great idea.
Right, a slick proposal for, say, marketing or a new feature. It gets voted through, gets 100% of the budget up front. And then, according to these critics, the results often didn't materialize. Sometimes the teams were just incompetent, sometimes dreamers, sometimes allegedly even worse. And the key flaw was no mechanism to claw back funds, no requirement to show progress before getting the full payment. Once the vote passed, the money was gone.
That must have been incredibly frustrating for the parts of the community that were building and delivering value.
Oh, hugely. It created a lot of internal friction, damaged trust, and hurt the project's reputation. The governance system, meant to be a strength, became a major point of contention, paying for effort or promises, not outcomes.
So is there a fix? What's the community pushing for now to enforce that accountability?
The main proposed solution is a pretty fundamental change to the payout structure, a mandatory two-vote system.
2 votes, how would that work?
Okay, so vote 1 approves the proposal, same as before, but, and this is key, it only releases 50% of the requested funds.
Only half up front.
Right. The other 50% is held back, essentially in escrow. It only gets released after the work is done, and there's a second vote by the masternode specifically to approve the actual results, the delivered work.
Okay. That shifts the risk significantly. The proposer has to deliver something concrete to get the rest of their funding. They have skin in the game beyond just the initial proposal.
Exactly. It forces accountability. You get paid for verifiable success, not just a good pitch. If they can actually implement this reform effectively, it could genuinely change the narrative around Dash governance.
Which brings us to the present. Because despite all that past governance turmoil, Dash has had this, well, remarkable resurgence in the market this year, 2025. We're hearing analysts talk about a confirmed multi-year breakout, ending a massive 968-day downtrend. What's driving this now?
It looks like a mix of things. Partly technical market structure breaking that long downtrend brings traders back in. We're seeing some pretty bullish price targets out there, like $157, even up to $440 being talked about.
Speculation returning?
Yeah, and it seems to be riding a wider wave of renewed interest in privacy coins generally.
Yep.
We saw Zcash rally recently too, so Dash might be benefiting from that sector rotation.
So privacy is back in vogue, maybe.
It seems so. And Dash has made some concrete moves too. Back in August 2025, they announced a partnership with NIM-VPN.
NIM-VPN, the privacy network.
Right. So now you can use DASH to pay for NIM's decentralized VPN service.
Right.
That's a solid real-world use case that ties directly into the privacy narrative. It strengthens its position in that niche.
And they also have their core roadmap, the new Genesis initiative.
Yeah, that's their big plan for 2025-2026, focusing on scalability, major throughput improvements, security updates, basically positioning the chain for future growth. But success there depends entirely on execution. They need to deliver on this roadmap without the kinds of delays or issues that critics say plagued past DAO-funded projects.
And we still have that challenge you mentioned earlier, the competition. Even with this resurgence, that 5-7% masternode ROI has to compete with DeFi yields, simpler staking on other chains. How do they keep those high collateral operators committed?
That's the crux of it, isn't it? The financial return alone might not be the top draw anymore. They really have to lean on the value of the Masternode functions, the InstantSend utility, the governance power. It has to appeal to people who believe in the project and want that control and utility, not just those maximizing passive income. It's a tougher sell than pure yield.
Okay, let's try and wrap this up. It's been a fascinating deep dive. We've seen Dash, a project that really innovated technologically, that two-tier network, masternodes enabling near-instant, super cheap transactions. Really impressive stuff.
Genuinely pioneering features.
But then we saw how that technical edge was for a long time overshadowed by these really deep structural problems in its own governance model, the DAO, and how it funded development. Paying for promises, not results, as the critics said.
And what's really striking is that Dash's future path might be less about inventing brand new tech, that payment tech is already pretty good, and more about fixing that foundational governance piece, making the funding mechanism trustworthy and effective.
Right.
The recent market rally is definitely positive, maybe fueled by that privacy trend, but for it to be sustainable, they likely need to deliver on those governance reforms like the two-vote system. Build on real accountability, not just market hype.
Which leaves us with a final thought for you, our listener. We've unpacked this whole debate around Dash's DAO, this tension between funding promises versus funding proven results. If decentralized governance run by the community is the ideal we strive for in crypto, how do you actually build a treasury system that ensures accountability? How do you guarantee performance without slipping back towards some kind of centralized control or bottleneck? When the voters are the stakeholders funding the work, what mechanism truly keeps everyone honest and focused on delivering results? Something to think about as this space keeps evolving.